yesterday. Dhiraj Agarwal is joining us now. He's co-head equities at Ambit Capital. He's been advising caution the last few times we've had him on the program. Dhiraj, good morning. Great to have you with us here. What's the view now? I mean, are we entering a bit of a risk-off phase here, not just here in India, but globally as well?
You know, you'll keep on hearing risk off and risk on every 3 months alternatively, because that's what, as you rightly said, that's what I've been saying on the channel for the last few times I appear, and I reiterate the same, that the market's likely to be range bound for quite some time to come. I think most of this year for sure, maybe even longer, who knows. So every time the market falls, it looks like world's coming to an end. Every time it tries to rally, it looks like we'll make a new high, and neither of the cases is a true picture. It's an okay market. It'll be range bound. It'll just keep on trading like this.
Dhiraj, hi, good morning. I wanted your thoughts on banks. There are a couple of problems that are plaguing the banking space, right? One is that the margins are expected to moderate as deposit rates catch up. And two, the deposit growth itself is expected to see a moderation as well. Do you think a lot of these issues have been priced into the banks? Because if you look at stocks, right, I mean, SBI is down almost 20% from the highs in December. You think it could get worse before it gets better? And is this a good time to be buying?
So selectively, I think, you know, one more point which I would like to mention is it's becoming very difficult and maybe counterproductive to actually paint the whole sector with the same brush. So as when I was listening to your commentary sometime back, that Mahindra CIE has done really well in the last 1 year as compared to most other auto ancillary stocks. And that's exactly what is happening, not just in that space, but everywhere else. So SBI, after the 20% fall, may be a good buy, but some of the other banks who are yet to fully price in the oncoming margin pressure may not be. And so two things are becoming very important. Within a sector, the stocks are moving in divergent fashion. And divergent not necessarily means underperforming and outperforming each other, but actually going positive and negative. So actually losing money or making money, that's one. And second, because of the range-bound nature of the market, higher interest rates and higher inflation, which we think will sustain for longer, markets have become very valuation sensitive. So your entry price has become very important, which was not the case, let's say, within 2014 to 20. You could buy at any price so long as the company was delivering good numbers and still make money. That's not happening anymore.
Hi Dhiraj, you know Dhiraj, the point that Sonia was making on Mahindra CIE, maybe some of these companies with European exposure, they could be bracing for a good coming year, you know, since there was so much of skepticism on them, and now those fears have not really worked out. Gas prices as well as lower, other input costs as well as lower. Do you think some of them offer a buying opportunity?
It's not a theme-based market at all. It's very, very stock-specific market. So to paint anything with the same theme that all export-oriented companies will do well, all Europe-facing companies will do well, all banks will do well, etc., etc., all of this is likely to go wrong. I think, you know, I compare the current market phase with what happened between 2010 to 14. If you actually go back and look at that period, no themes worked, but bottom-up stock picking worked. I think we are back to that phase.
Talk about a couple of stocks then, Dhiraj. In the past, I think you've liked Axis Bank, you've liked SBI as well from a couple of those banking names. Would you look to get into a couple of those stocks on this dip?
Yeah, we still like them. I mean, as you rightly pointed out, banking is seeing or will see and hence will price in some amount of margin pressure. In few cases, it might already have been priced in. So both Axis and SBI on valuations now look fairly reasonable. Can be looked at the current prices, yes.
Dhiraj, you compared the current phase to 2010 to 14. The rally started late 2013, right? Elections were in 14. So will we find ourselves?
Yeah, it started from 13. If you actually look at the absolute lows,
October. It was October, November 2000.
Sorry, I interrupted.
2003. Yeah. So, are you suggesting that is what happens next? Because next year we have general elections.
No, I was not actually comparing it to general elections. I was comparing more from a calendar point of view and the macro backdrop. So my thought was that the macro backdrop today looks very similar to that point of time. Slowing economy, stubborn inflation, etc. And the markets were range bound for almost 4 years. Remember, market crossed 2010 peak only in June 2014. So about 4.5 years later.
63, I think it was, 63.50 or so, right? That was the peak which held, and took a long time. Let's hope
yes, yeah.
we don't get to, we don't see that kind of market is just sideways, range bound, and hard to kind of. There was action, but as you say, very, very no real impulse one way or the other. No sectors really worked, and a pretty disaggregated kind of thing. Dhiraj, but across your research team, what are you guys getting?
Very stock specific, very bottom up. I think,
as they say, there is always a bull market somewhere, right? So where are you guys finding the bull market in right now?
Not in the near term, not this year, not this this year in my opinion. Maybe even slightly longer wait than that. So we'll see. We'll keep on reevaluating as we go along, but not in the near term. So as you rightly said, there's a bull market waiting somewhere. So there's a saying that you have to be at the right place, right time to be able to do well. So you just stand at the right place and wait for the right time.
You just need to know what the right place is, right? And when is the right time. But is this the right place and the right time for IT stocks?
Yeah.
Because we've seen a bit of a comeback there, and now companies are making acquisitions as well. The index itself is like up over 10% from the lows that we saw last year. Is this a good time to be buying IT?
So I think we discussed that last call as well. See, IT has outperformed the market, especially the banking space in the last few months. Maybe there is a little bit more. I mean, our strategists feel that there's a little bit more outperformance in IT. And that's more relative rather than absolute. So IT growth is slowing down. IT growth will get impacted because of slowdown in the US and Europe, even more than what's been priced at this point. But in the near term, what's happening is that we are seeing pressure on banking, we are seeing pressure on consumer demand, we are seeing pressure on metals, and autos are very mixed. Pharma is still struggling, and hence 8-10% growth of IT sort of stands out. It's a little bit more predictable. Last 2 quarters, IT results have not seen any earnings cuts after the results, so that's also helping. Bit of Nasdaq rally is also helping. So there are lots of relative factors working in IT's favor, which might continue to work for some more time.
Okay, by the way, just wanted to get a quick check on what's happening in the market, because it's falling further now. So the fall is pretty steep in the mid caps. The mid cap index is down 160 points. The bank nifty is under pressure. Z Entertainment is your biggest loser, down 7%, and the Adani group stocks are just getting whacked out of shape. So just track that. Dhiraj, what are your thoughts on how to, okay, you spoke about IT, right, and the moves that we've seen over there. What do you do with some of these new age tech companies? This is not the best environment for them. There are large scale layoffs happening. There's an impending recession as well, but many of them are returning to profitability. Zomato, Paytm, Nykaa. What do you do with these names?
I think you have to be selective. So we like a couple. We like both Zomato and BB. That's Policybazaar, and we like Policybazaar. I mean, it's a good now stable business. They're coming back to profitability. Stock prices have come off in both the cases 60-70% or 80% from peak, and at the current valuations, a lot of that the bubbly new age froth which was there has been skimmed off already. So time has come to start looking at some of these names constructively. I think there was a time when the markets lost a little bit of a sense of control on how to value the new age companies, and they were being valued on any parameter. And we have seen that movie in the past, right? We have seen the dot-com bubble in the past. So, but post the bubble burst, post 70, 80, 90% stock corrections, there are always a few gems to be bought and held for the long term. So I think that time is coming.
The time is coming. I think we saw there was a JP Morgan note, right, talking about new age companies and where things are starting to, if things are starting to turn, etc. Do you guys remember there was a famous, Warren Buffett made a joke. I mean, he was giving a lecture, one of his many lectures to students. He said, if I had to give a valuation exam to students and I'd hand out pieces of paper with questions saying, well, value this new age company for me. Anyone who gave me a right answer, I'd flunk. So
there is no right answer.
I mean, but stocks of course have seen 70-80% price damage, and maybe in some of these names, as Dhiraj pointed out, there is a little bit of value at the margin which is starting to emerge. Zomato is one that Dhiraj mentioned. The other is Policy Bazaar, right, Dhiraj? PB Fintech.
Yeah, that's right.
Okay, all right. We'll leave it there. Thanks very much, Dhiraj. Appreciate you joining in, and thank you for your time here on CNBC TV18. I think the market is down 60 points.